Hi and welcome to our Market Insight for March 2017. I'm Aaron Upcroft. I'm here with Rob Gilmore.
Good afternoon, Aaron.
Afternoon, Rob. So we decided this month that we'll choose a hot topic, one that has been in the press quite a bit recently. It's about housing affordability and more specifically about how we can get our kids onto the property market or into the property market, especially at times like this. But I suppose before we really delve into that, Rob, why don't you give us a bit of an update of what's happened since last month?
Well, look, in terms of financial markets, they've all generally moved in positive territory. It looks like the US is surviving a Trump presidency for now, and the data out there is quite positive, so expect a rate rise imminently. China is also quite stable as well, with some good data coming out of there. Here, locally, the Reserve Bank left rates at 1.5%. So continuing that trend of, I think, probably the rates are at the bottom of the cycle at the moment. And what are you seeing in the market?
Yeah, I am seeing some changes. As I alluded to last month and as we've expected, fixed rates are definitely still on the move. So they are creeping up with a lot of lenders. There are still a few rates left in the threes on the fixed rates, but they're diminishing. Investment loans still getting tighter as previous, so rates are increasing. Ratios are decreasing, so the amount you can borrow for investment loans is tightening quite a lot.
And interestingly, we are in a rising rate environment now, probably just the beginning of it, yet the property market is going from strength to strength. A really strong start this year, particularly in Sydney and Melbourne, compounding that problem of housing affordability. And so what are you seeing as some of the best ways to help kids, first home buyers, get on that property ladder when property prices are rising far more quickly than inflation?
Yeah, it's a tough one. I'll start with the easiest one that we see and the way that we'd like to structure it every time if we could, and that is for the parents to provide a gift. So this is a cash gift. It's provided generally before the mortgage is taken out, goes into the kid's bank account. So we avoid any issues of having to say that it's a loan and provide any misleading information to a lender. So we really want to avoid that, of course, but it's the simplest and easiest way to get the money into the kid's account and allow them to get onto the ladder.
So that raises a red flag for me when I see large cash gifts being given to adult children. From a risk management perspective, parents have worked long and hard to earn that money, and providing that to an adult children does effectively put it at risk with specific events such as relationship breakdown, where that asset, being a house, can be divisible under the family law process. So what I'd like to see is a gift structured as a loan to give that added protection to parents.
Okay, that can definitely work, and I think provided it's carefully planned, the timing is key. It's essential to get the timing right for that type of structure, so that we again just make sure that we avoid any misleading information going to the lender for the mortgage side of things. So provided that that's structured carefully, can work. Caveats can be put on properties after the mortgage goes on, so that it secure the parents' interest, and are very valid and absolutely verify that most of our clients who are first home buyers do apply as joint borrowers. So it is a common one, and provided it's carefully done, can work.
What about guarantees? Popular in the past. Are you seeing a lot of them these days?
Have been popular. All the banks, or all the majors at least, have products for them and have for a long time. There used to be two types. There was an equity guarantee and an income guarantee. The income guarantees are long gone. I mean, there might be one. I think there's maybe one lender left in the market for it. That's if the kids don't have the servicing capacity to service the loan. They're very rare, very hard to get these days. The main one that's left over is an equity guarantee, where parents put up a property, and hopefully it's their investment property and not their owner-occupied property, as partial security to help effectively avoid mortgage insurance. So they put it up as additional security to provide for the deposit. The thing is, though, is that the kids have to be in a position that's strong enough to be able to service that full amount of debt. So if they are, and the parents have hopefully an investment property on the side, that can work well. They do have products. However, it is a detailed structure behind the scenes. Parents have to get independent legal advice. There's some pretty detailed considerations behind the scenes.
Yeah, again, from a risk management perspective, I think if anyone's considering going as a guarantor for a loan on behalf of their children, they really need to be in a position financially to take on that property in the event of something impacting the ongoing ownership, which could be relationship breakdown, long-term unemployment. So really, I would, like you say, against an investment property would be much preferable, and basically some strong financial means behind the guarantee.
Yeah, I'd agree with that. The guarantees are limited guarantees, absolutely, but you wouldn't want to see the property sold under those circumstances. You'd want to try and retain it. So that's a very valid and solid approach to take for somebody considering giving a guarantee. What about other structures? I mean, they're the main ones from my point of view. Are there other structures that you commonly put in place or can consider for some families?
Yeah, look, absolutely. I mean, buying investment properties is a really important part of a long-term wealth creation strategy, and having a strategy to buy a property for your kids is a great one. And it could be buying that property when they're young, negatively gearing that over a number of years ahead. So effectively they are on that property ladder well and truly before they actually need to live in a property. And it can also be a valid strategy to buy an investment property and rent it out to adult kids and negatively gear it. Alternative structures.
Can it be done in trust, super, or things like that?
Again, you need to be mindful of when to put an asset in a trust, but it certainly is possible. Depends on personal and income circumstances. Within an SMSF, no. Primarily because an SMSF, you're not allowed to rent that property or use that property for personal use, and that would include
related
children.
persons.
Yeah.
Is it? Yeah. Okay.
Yeah. But certainly buying a property for each of your kids is a great strategy if you've got the financial means.
Yeah, it makes sense. So where to from here? Families considering this, which option do they take? What are your thoughts?
Well, look, obviously we've been through a number of considerations in terms of how you do it, and I think the approach does vary in terms of personal circumstances, and
Absolutely.
there certainly are risks involved. So I'd certainly say if you're thinking about it, get some advice.
Absolutely. Well, that's our market insight for March 2017. We'll see you again next month.